Today's topics. What are today's topics? Today's topics are depreciation and break-even point. Depreciation is really conceptual for the most part. It is, we won't use it in this class, but you need to have an understanding of what the concept is and what it does for your financials. You will not need to put depreciation on your financials for your for the business plan. The reason for that is usually depreciation is calculated at the end of the year, not on a monthly basis. But you do need to understand what the concept is and what it means for your business. The second concept is a concept that I really like. That's break-even point. For me, it's a tool for business people to know when you're going to be profitable. And that's a really, really important thing to know because I guarantee you an investor is going to ask, what's your break-even point? When are you going to be profitable? How long am I going to have to put money into this business, or how long is it going to be until I get my money back? So that's break-even point. Couple of things to know about the examples that I provide. First of all, I'm going to give you multiple videos on break-even point. The first is this lecture, and I include both samples for product-based businesses and a service-based business, which is mine. The second video that you're going to have is called Why Variable Cost is Never Zero. That's a really important video. And then the third is a video that is I'm going to take you into one of my hobbies, which is making soap. Someday it'll be a business, but for right now, I just like to make soap for my friends and family. And I'm going to show you how I calculate my variable costs for when I make soap for my friends and family. Not because I'm selling it, just because I like to know. I don't know why, I'm a geek. Anyways, so let's take a look at depreciation and break-even point. Two topics today, depreciation and break-even. Let's start with depreciation. Depreciation is basically this concept that allows a business to capture the decreasing value of an asset. When you buy assets for your business, they lose value naturally. For example, the sofa behind me, I don't know if y'all can see it, but there's a sofa behind me. The sofa behind me, I've purchased for my business. It gets used, and over the course of time, it's going to wear out. And so depreciation allows me to account for that value of wear. When you purchase a car, there's a saying that the minute that you drive a car off the lot, you're losing hundreds, maybe thousands of dollars. That's true. The vehicle depreciates almost immediately. And so depreciation allows you to capture that lost value on your financial statements and give you some benefit for that. So to calculate depreciation, we need to know three things. First of all, the original cost of the asset. Second of all, the estimated useful life. And then third, the salvage or residual value, what it's worth at the end of its useful life. So to calculate depreciation, we take the cost and we subtract the salvage value. With that, we divide by the estimated useful life. Let's say that I have an asset that I purchased for $25,000 and I plan to use it for 5 years. And at the end of that 5 years, its value to my business is basically going to be zero. So for me, I take that $25,000, I divide it by 5, the number of years of useful life, and I get $5,000 a year of depreciation expense. Something to note, very few of your assets will actually be worth zero at the end of their useful life. However, what you do is if you take that asset and you wind up selling it, then you treat those sales as an additional source of revenue. We don't need to go there, and that's probably a side that might be a little bit too complicated. We're just focusing on the concept of depreciation and how it works for your business. So let's take a look at what depreciation does. So let's say without depreciation, I have revenues of $100,000 and expenses of $50,000. That makes my net income or my taxable income $50,000. Okay, now let's say that I have an asset that I have depreciated, that $5,000. Okay, well, it gives me revenues of $100,000. I have the same $100,000, but I have an extra $5,000 of expense. And so it increases my expenses. And by doing that, I have decreased my net income. So instead of paying tax on $50,000, I'm paying tax on $45,000. Now, something to note, you're not actually writing a check for depreciation. Depreciation is recorded as an expense, but it's technically a non-cash expense. It is an expense that you incur through the decreased value of that asset. Again, you're probably not going to put depreciation on your monthly financial statements. It's generally something that you record at the end of the year, but it's an important concept that you need to kind of have an understanding of, because it can certainly help when you're calculating your taxes for your business, for example. Let's try this one. So you've got an asset that you purchased for $60,000. It's got a useful life of 10 years and a salvage value of $10,000. So try that one, and then try this one. Asset of $75,000, salvage value is 0, useful life is 5 years. I almost said 5,000. Useful life is 5 years. So calculate on your own the depreciation expense of those two assets. I'm going to give you a minute. Push pause. Do whatever you got to do. Okay, minute's up. So for our $60,000 asset, you should have $5,000 of yearly depreciation expense. That's because we take the $60,000 and we subtract that $10,000 salvage value, which gives us $50,000 that we can depreciate over 10 years. 50,000 divided by 10 is 5,000 per year. $75,000 asset divided by 5 is $15,000 per year. If you didn't quite get those, please feel free to reach out, and I'm happy to work with you on those. But relatively straightforward concept, depreciation. Let's move on to the concept of break even. Before we get into break even, let's talk about costs and how they behave. There are typically 3 types of costs that you will encounter in your business. We have fixed costs, which are costs that don't change with the level of production or with the amount of business that you're doing. So for me, my rent is consistent every month. My utilities are pretty consistent every month, actually. My insurance is consistent every month. So those are my fixed costs. And then my variable costs change with the level of business, the amount I pay my employees. If I'm super busy, I need more employee support. If I'm slow, then I have fewer employees, and maybe I'm doing a little bit more myself. So that is a variable cost, changes with the level of business. And then mixed costs are costs that have both fixed and variable characteristics. Data storage, you pay a certain amount for maybe 100 gigs or a terabyte, whatever. And once you hit that fixed amount, you pay extra per gig or per byte, whatever it happens to be. Square, credit card transaction fees also have both fixed and variable costs. You pay for the service and then you pay per transaction. And so that would be a mixed cost as well. So cost behavior, important factor into calculating our break-even point. And break-even is basically that place or the amount of sales that you need to acquire before you hit your first dollar of profit. So the first unit after your break-even point, you are in positive territory, or you are, we would say, in the black. You are making profit. Break-even can be expressed both numerically or graphically. There are a lot of, you can just go on Google and Google break-even point calculation or break-even point graph, and you'll get something that'll allow you to put your cost numbers in and your sales, and it should give you a nice graph. I like to do the calculation because I think the calculation is more intuitive. And so the calculation for break-even point is pretty straightforward. Your fixed cost divided by your sales price per unit minus your variable cost per unit. And like I said, this can be expressed numerically or graphically. Break even. $10,000 in fixed costs, our sales price is $20, and our variable cost is $15. $10,000 on the top, 20 minus 15 on the denominator, and so we've got 10,000 divided by $5 per unit, and that gives me a break-even point of 2,000 units. That means that at 2,000 units, I am not profitable. At 2,001 units, I am. One for you to do on your own. You've got fixed costs of $25,000, sales price of $25, variable cost of $10. Take a minute. Okay, so this one is an interesting one because what you come up with is, or you should have come up with, $1,666.67. With break-even point, if you get a decimal, you always round up because you cannot make 0.67 of a product. So if your answer is 1666.67, it's actually 1667. Remember that break-even means that you've made 0 profit. You need to add 1 unit for profitability. If your break-even comes out to a decimal, like I just said, you always round up. If it's 101.2, then it's 102 for break even and 103 for your first dollar of profit. One of the really cool things that I like about break even is that you can factor in your target profit. Let's say that I know that I want to make $5,000 a year in extra profit. So I just add that target profit to my fixed cost like it's a fixed cost itself. So instead of $10,000, I would have $15,000 in my numerator, divide by 5, and my break even becomes 3,000 units, and that guarantees me my target profit of $5,000. So take a minute. $10,000 in fixed cost, $10,000 in target profit, sales price of $20, and a variable cost of $15. Okay, did you get $4,000? If not, reach out to me and let's talk about where you might be going wrong there. Break-even point for you for that problem should have been 4,000 units. 4,001 unit for your first dollar of profit. When we are calculating break-even point for businesses that have multiple products, very few businesses sell just one thing. And so we have to calculate break-even point differently when we have a variety of products. And so what we do is we list out all of our products and the percentage of sales that they add to the business. So here I have a business that has $10,000 in fixed costs. We've got 3 products. Product A is $25, product B is $15, and product C is $10. What I need to know for multiple products, again, is that percentage of sales. So product A is about 60% of my sales, product B is about 20% of my sales, and product C is also about 20% of my sales. What I do is I create product D. So in order to do that, what I'm doing is I'm calculating my sales price by taking my $25 sales price, multiplying it by that 60% or 0.6, adding $15, adding product B, $15 multiplied by that 20% or 0.2, plus $10 multiplied by 0.2 or 20%, which gives me a sales price of $20 for that product D, which represents these 3 products in this proportion or this ratio. Calculating my variable cost is just the same. $15 times the 0.6 or 60%, add $10 times 0.2 or 20%, $5 times 0.2 gives me a variable cost of $12. Now I can do my break-even point calculation, 10,000 divided by 20 minus 12, and that gives me 1,250 units, $1,251 would be my first dollar of profitability. So far, you're seeing this kind of set up in tables. I just want to give you guys an example of how you can do this on paper. I do this a lot on paper. I actually prefer to do it on paper. So here is my break even for my low season, which is like November through April. So when I calculate out my fixed costs, I have my rent, which I pay $2,000 a month to myself. My insurance is generally about $67 a month. Well, it is $67 a month. My cable Wi-Fi is $88 a month, and my utilities generally run me about $40, which equals $2,195 in fixed cost each month. My variable costs are my cleaning, myself. I'm always going to pay myself in there. And then I also provide about 10% of the nightly fee. I have like a snack allowance and I buy people snacks. So my place has a 2-night minimum, and that's important because that cleaning per night usually is not $150, then it would be $75. And I will talk about these crossouts. It's a little mistake I made earlier. I'm going to talk about that in a few minutes. In my low season, my weekly sales price is $165 and weekend is $220. Calculate my break even. So I just have usually the low season, my weekday is about 10% of my sales and my weekends are 90%. Always November through April is generally strictly just weekends with some allowances for the holidays. But like I said, I want to make sure, I want to be conservative in this estimate. Sales price $115, variable cost $115. Sales price $165, variable cost $115. It's 10% of my sales, so I've got 165 multiplied by the 0.10, adding my 220 gives me a sales price of $214.50. And then you can see my variable cost, which is always, when it's the same for each of your products, it's just going to be the same. But for some reason, I like to do that. Break even. So I've got my $214 minus my $115, which is $99.50 a night. 22 nights during my low season is what I need to break even. Some things to note about that. My business is seasonal. Most nights in my low season, I won't hit that 22 nights. But when we look at my high season, that's a different story. And so in my high season, my variable costs are $21.90, same pretty much all the way around. I did forget in my first calculation to throw in my paper goods, which is really negligible, so I'm not going to worry about that. My sales price during the weekdays in high season is a lot higher, same with my weekends. And so because of that, when I do my calculation, I've got $295 for my sales price, $125 for my variable cost. It's 73% of my sales in the high season. Remember, it was 10% in the low season. My weekends are 27% in the high season. They were 90% in my low season. So my product C, 304.45 minus 125. I take those two. I've got 179.45 in my denominator, which gives me 12.2 days. I'm going to round up to 13 days. The reason why I can get away with the low season of 22 nights that I know I'm not going to hit is because my high season is only 13 days, and in the high season, just about every night is full for me. So my high season very much makes up for my low season, if that makes sense. One thing I wanted to point out, in full transparency, when I initially did this, I did it wrong. What happened was that I wasn't thinking about my 2-night minimum. And so I added an incorrect number in my variable cost, and I wound up with 36.89 nights. It's pretty hard to have 36 nights in a month that only has 30 days. So, and that's an important message. When the calculation comes out and has you scratching your head, if it's a negative number, your break even is never a negative number. You need to go back and see what you did wrong and think about it. If you're having problems, reach out to me and I can help you get through that. No problem. This is definitely another concept that students tend to have challenges with, and my job is to help you figure it out so that it makes sense to you. So here is your turn. I'm going to post the answers to this in Canvas. You can either copy this down, you can print this particular slide up, however you want to do it, but you're going to assume fixed costs of $15,000. You've got your multiple products, and hopefully you have gotten enough break-even practice throughout the lecture that this should be a piece of cake for you. Okay, that was depreciation and break-even point. Hopefully you enjoyed it and it made sense to you. If you didn't enjoy it, I can't really help you with that. But if it didn't make sense to you, I can help you. Just reach out to me, let me know where you're struggling, and let's set something up and figure out how we can calculate your break-even point.